So, introduction to forex trading. So today we're going to be looking at forex trading. If you're new to forex trading, you're in the right place. If you have some experience trading, you might also want to stick around because you'll probably learn a few things. And then in subsequent classes, when we start looking at more in-depth and advanced stuff, you'd also be able to to gain access to them. So today we'll start off with forex trading. I know forex trading is something that has quite become quite popular. A lot of people seem to know about forex trading. So we'll break it down and see how the market works. We'll also look at how you can make money trading in forex. It's also important to put out a disclaimer here that says when it comes to forex trading, there are risks associated with trading, and so it's this is like a disclaimer you have to put out there. Now, what we're going to cover today would look at what forex is. Would also look at why you should consider trading the forex market. And then we'll see some of the basic terms you need to know in order to be able to trade forex. And then we'll now wrap it up with looking at how to make money trading in forex market. True, we can't cover all you need to know on forex on this course. But after this course, if you have no idea about forex formally, you should be able to understand in depth what forex is, what forex trading is, and how it works, and how money is made in the market. Now, I'm your host. My name is Nana Obina Alexander. I'm a trader for several years. I've been trading for several years. I'm a forex trader, and I'm also a trainer. So let's kick off without wasting any further time. What exactly is forex? Well, forex is short for foreign exchange. So just as you can see, forex is an acronym for foreign exchange. Now this is a market, a global market where currencies are traded. So what that means is online forex trading is an online market where currencies are traded. So or exchange, so one currency for another. So you have Euro, USD, Nigerian Naira, the Great Britain pound, all of these currencies, they are all traded on the forex markets. Now, you'll be wondering, how do you trade currencies? How do you buy and sell money? Well, what we basically are looking at, or what the forex market actually entails, is actually exchanging one currency for another with the aim of making a profit on the difference in exchange rates. We'll then break that down in a bit. Well, one thing you need to know about forex market, it's that it's a decentralized market that is run electronically. Now, what this means is it is decentralized. It is not controlled by anyone, maybe government or company. It's not controlled by any single company or any single government. It's a decentralized network of banks. So by banks, I don't mean the GT and the Zenith. These are the main banks and liquidity providers. So the forex market is open 24 hours a day, 5.5 days a week. The size of the forex market, which is one of the biggest advantage of the market, is that it's really, really huge. Every day, $6.6 trillion is traded or exchanged on the forex market. So what we'll be looking at is how we can make some profits out of this huge pool or this huge pile of money. So if you've been looking for the huge pile of money, the forex market is the biggest market in the world and quite easily the most profitable market in the world if you know what you're doing. Now, some of the advantages of trading forex, you can break them into four main categories: the flexibility, the size, the liquidity, and the simplicity. We just looked at the size. The size of the forex market is huge. Every day, $6.6 trillion is traded. There's no other market comes close. The nearest, the biggest one after it is the New York Stock Exchange. That one trades about 40 billion a day. Now, if you compare 40 billion to 6.6 trillion a day, you'll see that the difference is enormous. Now, so this size offers high liquidity. It means that transactions are placed or taken very fast. So if you sell or you're buying, the orders are filled instantly. The flexibility of the market also means that you can trade forex while still keeping your job. So if you learn how to trade forex, you can also be trading forex markets while you still keep your job because there's several multiple deciding factors when it comes to your success. on the forex market. It is also quite simple. The basic concept of forex trading is actually easy. You understand that the idea of forex trading is to buy the market or buy currency pairs at low prices or sell at high prices. So just the same way you would look to do in a normal business, you look to buy or sell currency pairs or exchange one currency pair for another at a price such that you make a profit. We'll look at an example using a local. We use the naira against the dollar to do an example. But first, let us look at another important reason why forex trading is something you should consider doing. History has shown that sorry, that during the financial crisis or during the tough financial situation, other sections of the economy tend to suffer. So the stock market tends to decline, real estate transaction tends to freeze up, and even retail sectors, which are usually hit the most, suffer high losses. You can use the corona as an example. Businesses that were thriving and were feeling on top of the world, the corona, which is a financial crisis, came and shaking up the economy. The stock prices were down. Stock markets was people were not really buying stocks, and then you have real estate transaction freezing up, and most importantly, people's small businesses, medium scale businesses, even big businesses, they went into bankruptcy. But the forex market, on the other hand, can remain profitable even in the worst of times. And in some cases, even more profitable in worse economic situation. And this is because currency pairs or currencies are always traded in pairs. We are in the forex market. What we do, if you notice what I said earlier, is that forex trading involves exchanging one currency for another in a bid to make profit from the differences in prices. So you're always pairing two currencies together. We'll see how that works when I use the example of the naira. Now, in every business, money is made by buying goods or maybe creating a services at a low price and then selling those services or those goods at a higher price to make a profit. So you don't understand that in order to make the money, you have to buy at some point and then sell at some point, and the difference between the price you bought and the price you sold is the profit you earn. Now it's actually the same with forex. The only difference is this time we are not buying anything physical. You're not going to buy a phone or a laptop. You're not buying anything physical. You are actually selling and buying currencies. Now, I'm sure we're all familiar with exchange rates. So if you go to the bank, you see the symbol that moves that shows the exchange rates, the current exchange rate of maybe the dollar against the naira, maybe the pound against the naira, and you see those exchange rates there. Now, in forex markets, those that is actually what our concern is now, because these exchange rates, they are not stagnant, they are always adjust, they're always moving and fluctuating. That's why you can see yesterday the price of dollar to the naira might be 460, today it might be 465, or maybe not even today, or maybe the next 5 minutes it might go up. And because the exchange rate is always fluctuating, always moving up and down, bouncing around the corner. If you think about it, if you can, make to a certain degree a calculated estimation of where the price would go in terms of whether the price of dollar or naira would increase against the other, you can make profit physically by buying dollars and selling it. Now, here's an example. Let's imagine this, just theoretically, let's just imagine that you decide, okay, you want to get the dollar. So you go to maybe the bureau de change or maybe any of those bookies that sell dollars, and then you say you want to buy dollars. Say, okay, what is your rate? And it says, I'm selling at 400. So you go and you say, okay, give me $1,000. And it says your money is 400,000. You pay him 400,000, he gives you $1,000. Now, take note, two currencies are involved, the USD and the Nigerian Naira. The rate at which you did this transaction was at $1 is equals to 400 Naira. Now, 1 week later, or maybe 2 days later, or something, the you see that the exchange rate has gone up from 400 to 450. Now you go back to the bureau to change and you say, okay, I want to sell my dollars. You say, how much dollars do you want to sell? You say $1,000. It's okay, I'll give you 450,000 for your $1,000. Now you give him the $1,000, they transfer 450,000 naira to your account, and you can see that you made a profit of 50,000 simply by buying the dollar at the right time and then selling the dollar at the right time because the exchange rate has adjusted or has increased. Now, this is exactly what we do in the Forex market. The difference is we don't need to buy physical dollars or physical currencies. And unlike this one, you know you can only deal with the naira and the dollar. But in the Forex market, we're not buying physical currencies. We're actually trading the exchange rate. And then if you notice in this example, we needed the currency to go from 400 to 450, which is a lot, before we could make 50,000. But in the Forex market, when we look at the exchange rate, unlike what the banks would look at, let me go back to this example. You would in the exchange rate that would consign you if you're buying physical currencies is the $1 and the 9 cents. So you would not really be concerned about the banks would not even show you these last two pips, these last two values. It's just the dollar and the cent because this is where the cent goes out. And if it were naira, it would be the naira and the kobo. Kobo goes out at two decimal place. Now, but behind the currency pairs move less than kobo. Now, what we do in the forex market, we don't necessarily need. That is why we don't necessarily need the price to go up by a lot. Like in this example here, where you have to go up by 50 naira. We don't need the currency pair to go up by a lot, and this is why we'll explain. When I explain a little bit about pips, you would get a understanding of that. Now, like I've been saying, what we do in forex market is trade currencies. Now, the major currencies that you'll be looking to trade or that we trade in the forex market, the major currencies that we trade in the forex market are some of these. So you have the US dollar, the euro, the Japanese yen, the Great Britain pound. You have the Aussie, that's the Australian dollar, the CAD, the Swiss franc, which is the CHF, and the NZD. So these are the major currencies, and you can see their country on the side. Now, these are remember we said something. We said in the forex market, currencies are always traded in pairs. So what we trade are a combination of them. So you can have the US dollar against the yen, the euro against the dollar, the pound against the dollar, the Australian dollar against the dollar, the CAD against the dollar, or the euro against the yen, the pound against the yen, a permutation of them. So this gives you a wide variety of options to choose from. Now, this is one of the major advantage of trading forex. Like if you another thing you can relate to trading forex is investing in the stock market. But unlike the stock market, you only need price to go up before you can make money. Like if you buy the stock, say you buy Zenith stock or GT stock or Dangote stock, you need to you can only make profit if the price of the stock is going up. So if you buy at say 1,000 naira per unit and it goes up to like 1,200, you make money. But if the price of the stock is going down, you are losing. You can't make money if the price is sinking. But in the forex market, it does not matter where the price is headed. If it's going up or if it's going down, you can make money trading the forex market. And this is one of the huge advantages of the forex market. Now, what do you need to become a forex trader or to start trading? Actually, you need everything you need to start trading is within your grasp, and I can say that with a certainty. And if you're watching this during this training, then you have a smartphone or a PC, and you have internet connection, so you have the two on the left. Now, you also need a startup capital, and in GC markets here, you can even start trading with as low as $20, as low as $10. Although it will be, if you might want to start up with a little bit, but you can start trading the forex markets with as low as $10. And then GC markets will provide you with the brokers platform to be able to trade the market and connect to liquidity. So everything you need to trade the market is in your grasp. Remember when we were looking at the advantages of forex trading, we said because of its simplicity. So you can trade from anywhere. If you from your office, if you learn how to trade, you can be in your office, take your trades maybe in the day, maybe within the day you check your trade, maybe close your trades. You can trade at night. You can trade from your phone, from your laptop, anywhere. So it's actually quite straightforward, and you don't need to, quit your job or quit what you're doing and learn how to do this. And you have to wait. If you want to learn how to do mechanical engineering or whatever, you have to really put all some of your attention to that. But you can do this on the side, learn how to trade forex, and be profitable in this business. Now, some of the basics of forex trading. What are the things you need to know in order to start feeling like a forex trader? Now, one of the most important things you need to understand is what we call a PIP. PIP. A PIP stands for price interest point. Now, if you remember what I said earlier, it's the PIP is way lower than what the exchange rate you would see on your what you call it exchange, let's say in the bank. And in the banks, they will usually approximate to two decimal place. Now, in the forex market, we are concerned about the last, not necessarily the last, the fourth decimal place in most currency pairs, except pairs that have the Japanese yen. Those ones to go out at the second decimal place. Now, what PIP is, it is the smallest value that a currency pair can increase or decrease by. Now, let us think it. It is the smallest value that a currency pair can increase or decrease by. So in terms, if I were to use an analogy of time, we count time in terms of 4 hours, 1 day, 5 weeks, But the minimum, like for humans, the minimum we calculate in terms of time is second. So 1 second, 1 minute, 1 hour. 1 minute is a fraction is a combination of a lot of seconds. Even 1 hour is a combination of a lot of seconds. So 60 seconds gives you 1 minute and so on. So a pip is the smallest increment that the smallest value by which a currency pair can increase by. Now, in this example, where you have the exchange rate of Euro USD equal to 1.0905, the pip here is this 5. So if the value of Euro USD on the forex market increase by 1 pip, it will go up from 1.0905 to 1.0906. So that is an increment of 1 pip. And then if it decrease by 1 pip, it will go down from 1.0905 to 0.904. So that's a decrement of 1 pip. Now, in the forex market, each of these currency pairs, they move on the average. The euro USD move around 70 to 100 pips per day. You have currency pairs like the pound pairs or the NZD, the euro NZD that move up to 200 plus pips every day. Now, this is interesting. This is very important because when we are looking at how we make money, a pip or understanding pip or just knowing that what a pip is and how it works is key to how we make money in the market. And this is because when we trade in forex markets, buying or selling, the aim is to gain pip, to capture as much pip as possible. Now, why is that? Now, if for example we have, let's say we bought this pair. So on our broadcast platform, so on GC Markets, we place a trade, say buy Euro USD. So if we buy Euro USD at this price, 1.0905. Now, when we buy, just like when we buy, you are buying in anticipation for price to go higher. So when you expect price to go up, we look to buy. When you expect price to decrease or when you expect the value of the exchange rate to decrease, we look to sell. Now, if we buy Euro USD at this price and it goes up maybe within the next, maybe we place a trade and it goes up from 1.0905 to 1.0925, that means it has gone up by 20 pips. Now, this might happen within an hour, maybe within some minutes, maybe within 2 hours or something. Now, if the trade goes 20 pips in our favor within that period, that would equate to money. But the value of money to equate to would depend on something we call a lot size. Now, a lot size is just saying the volume of transaction you are doing. What this means is, well, the simple way to explain this is, each there are three major types of different types of lot size. Now, each of these lot size, depending on the one you're using, would determine the value of the pip you capture. On a standard lot, when you use a standard lot, the value of one pip is $10. When you use a mini lot, the value of one pip is $1. And when you use a micro lot, the value of one pip is 10 cents. Now, if we go back to this example, if we buy Euro USD at this price and it goes up to 1.0925, that means it increased by 20 pips. We've gained 20 pips. If we close our trade at that price, the profit we'll make will be dependent on the lot size we use. So if we use a lot size of one standard lot, that means we've made $10 per pip times 20 pips that we made. So that will be equal to $200 on that trade. So you made $200 on that trade because the currency pair moves 20 pips in your favor. That's happening a short period in an hour, in minutes, if even. Now, if you're trading, you also need to understand too that the pips you could potentially gain is also the value of the pip you could potentially gain is also equivalent to the value of pips you could also potentially lose. So if, for example, you take a trade and it goes against you and closes against you, maybe 10 pips, you would also take a loss of 10 pips depending on the value of the lot size that you're using. So for a mini lot, one pip is equivalent to $1, and for a micro lot, one pip is equivalent to 10 cents. Now, a good if you I hope this is actually quite clear, but a better way to kind of explain the lot sizing is this. Imagine if we go back to our example of the stock market, so the Nigerian Stock Exchange, and say you buy maybe Dangote stock, let's assume the price is at 1,000 naira per unit. And so if you bought 100,000 units at 1,000 naira per unit, and then somebody else, let's say I bought 10,000 units at that same 1,000 naira per unit. If the price goes up from 1,000 to 1,001, the profit you will make will be that extra gain, that's 1 naira, that is on top of the 1,001. So the 1 naira times the number of units you have. So because you bought 100,000 units, you will make 100,000. And then because I bought 10,000 units, I'll make 10,000. Although the price increased by the same, it's still the same 1 naira that increased by, but because of the volume of unit I bought, and reward will now determine the amount of profit or loss that is made. So when you combine the lot size times your and the value of the pips, the amount of pips you captured, that will now equate to the profits made. Here's an example of that. So if we buy, or like we like to say in the forex market, if we go long, so long is equals to buy and short is equals to sell. But if we buy the Euro USD at this price, say 1.1950, and we close our position at 1.1970, which is an increase of 20 pips, we see that it has increased by, we gained 20 pips. The profit made will be 20 pips times the value of our lots. So if we are trading a standard lot, that will be 20 times 10, which is $200. For trading a mini lot, it will be 20 times 1, which is $20. And if you're trading a micro lot, it will be 20 times 0.1, which is $2. So depending on the lot size that you're trading. And in order to trade, if you have a small account, evidently you'll be trading a smaller lot size, and so that you don't over risk over put so much pressure on your account because you have to calculate the risk involved. Now, another thing you also need to know is also something called candlesticks. So if you've seen forex traders, you know they like to look at their charts. So you also need to understand this candlestick. So candlestick are actually quite simple. So they usually you can adjust the color however you want, but the white candlesticks will represent bullish candlesticks, and the or white or green, and then the black or red will represent bearish candlestick. Now, what this means when you hear the term bullish and bearish, bullish it just means going up. So bull, I just imagine a bull nudging an animal, it tends to hit the animal up. So bullish means going up, while bearish means coming down or falling down. So a bullish candlestick is one that closed at a higher price than it opened, and it's appreciated. It closed at a higher price than it's opened. So in this case, what you're seeing here, what this candlestick is showing here is saying the price opened at this level, but during that duration, it went down as low as this level, and then during that same duration, it went up as high as this level, but successfully closed at this level. So you can see it opened here and appreciated. and closed here. A bearish candlestick is one that closed at a lower price than it opened. That means it depreciated during that period. So you opened here, went as high as this, went as low as this, and closed here. Now, there's something you need to understand about the forex market. Let me use a drawing board here. So the forex market, the reason we're able to make money in the forex market is because we understand the way the market works. Now, the forex market is a place where price is never stagnated. As long as the market is open, price is always on the move. So price is trying to go from point A, going from point A to point B. But here's the thing about the forex market. The price never goes from point A to point B like this. It never does that. Instead, what we'll have is price tends to go is kind of a wave-like pattern. You notice it still went from point A to point B, but it didn't just go in a straight line. You see that price tend we notice what we know is that price tend to move in a zigzag or wave-like pattern. Now, because of this knowledge, because we know that is how price function, it is it's not as experienced traders when you get good at the market, you'll now be able to position yourself to enter the market at areas or buy the market. Say if you were looking to buy, you'll be looking to buy here, and you see how if you bought here at, let's say this price is 1.1, and then this price is, let me say, 1 point or 2.1. So buying here, you could see that there's an appreciation in price. Now, if you also sold at this price, you can also sell here. Remember, in the forex market, we can either buy or sell. So if you sell here, you can sell at a higher price and then close out at a lower price. So you notice the aim is to buy the market such that when the market moves, it goes up in our favor. It's more like you're buying. If you buy you're doing business, and so you buy a product and then sell it much later when it's higher, or maybe when there's scarcity and you sell it and it has appreciated. So you're looking to buy at a higher price, at a lower price, and then sell at a higher price. Now, so if the market is moving higher or is going up, we look for opportunities to buy the market. And then when the market is falling down or coming down, we look for opportunities to sell the market. And when it comes to forex markets, we profit in the market because we know these patterns are repeatable. Forex trading, there's no secret to forex trading. It's actually a formula. You understand how the market works. You learn to trade the market with the market system. Then you learn how to make money. Now, a lot of people lose money in the forex market because they do not understand the way the market works properly. Now, in the forex, when it comes to forex trading, you're not making money. All your trades doesn't have to be profitable for you to be a profitable trader. So you can take 10 trades and you can even lose three or four. You can even lose five and still come out profitable. The idea is to what we do here. If you sign up with us and join us on our platform here, we would guide you from being having no idea at the forex market, and even if you have some idea but you're not really profitable in the market, will help you to gain more vast knowledge about the market, so you can go from to become a profitable trader. Now let us go to the chat, and we've talked a lot about. Let's go to the chat and see some of the things we've been talking about. Now, so I'll just pull up a random chat. Okay, let me pull up something that is blank. Okay, so let me take out this. Now, this is what the typical Forex, if you're using a desktop version or you're using it on your desktop, this is what you would see in the market. Now, if you're looking at the Forex market for the first time, this just looks confusing. It kind of looks like all those stuff that you see in the hospital that moves in zigzag pattern. But what you're seeing here is just interaction between price and time. So if you look on here, my right hand side, you can see the price at this side. So you can see then under beneath here at the bottom, you can see time, so dates and time. And then you can switch between time frames. So you have 1 minute time frame, 5 minute time frame, 30 minutes, 1 hour, daily, weekly, even the monthly time frame. Now, notice about what I said before. The market doesn't move in a straight line. The market moves in wave. So when the market is going up, it moves in zigzag pattern. Now, if you can follow my mouse, you can see here that you see the market at a low price here, going to a high price here. But the market moved, it kept going up, coming down, go up, pull back down, go up, pull back down, and then that is how the market works. If it's coming down, it also moves in a wave. It doesn't make straight line down. So it comes down, pull back up, comes down, pull back up. It keeps pulling back up. So now this, because we understand that this is how the market works as technical analysts, when you in subsequent trainings, you would learn how to really analyze the market from a technical perspective. So we'll teach you support and resistance. You'd also learn price action candlestick. The chart, or the forex chart, has signals or signs. It has sign language. There's a sign language to the market that could give you an insight of what price or what the market is about to do. So if you can read those signs properly, you'll be able to make profit net profit consistently over in the market, and be able to gain profit, gain a lot of money in the process. Now, concerning the pip, this is what we're looking at, is the daily time frame. If I maybe move to the 1 hour time frame here now, and let us see. So this is the 1 hour time frame. So in this setting, for example, if you had the value of this pip. So today, the GBP NZD has moved over 150 pips. That means if you sold this pair, like if you placed an order as a new order, and say you sold this pair, let's say 8 hours ago, you would have been up by 150 pips, because the difference distance from here, you can see the price at that point. So here, current price, so the low here, or even current price, is around 150 pips. So that is, if you're using a standard lot, you do the multiplication. That is a 150 pips times $10, which is $1,500. If you're using a mini lot, that will be $150. And if you're using a micro lot, that will be $15 profit on just this currency pair, if you had traded this currency pair selling. Now, there are a lot of currency pairs. You have over 40 different combination of currency pairs and commodities, and even precious metals like gold to trade from. So you can even trade Bitcoin, cryptocurrencies on our platform. You can trade gold. You can even trade the oil, the price of the oil on our platform. So the forex market is an exciting place. Is an very exciting place to be. Now, if we have traders, people who are currently trading the market, here is kind of like a teaser. So this is one play it's kind of looking interesting. We're looking at what the markets, watching for what the market will do on our private Telegram channel for our clients who have funded their account. We have this analysis there. So on this pair here, that is the Euro USD. So we're looking for, the market is actually setting up quite nicely. You see how the market is rejecting the downside of the backside of this broken support, now new resistance. And if you're currently trading, you might be looking to trade this pair. It's still, it still has about 135 pips to its target, and the stop loss, where you should place your stop loss, should be above here. So that is for people who already have some experience trading, and so at least you gain something by being here this long. Now, true, there are a lot of things we've talked about that may not be so clear to you, but don't be bothered, because we are here to help you through the process. So we'll have subsequent classes, and there are also some resources online if you want to continue to get better at this business of forex trading, so that you can see how to make your own share, get your own share of this $6.6 trillion that is being exchanging hand every day. Then you would want to make sure that you get good at this business of forex trading. Now, let's go back to our chat. Now, here there are also other, you might be looking, oh, this thing is a little bit confusing, or where do I get from where I am now to being able to make, big consistent profits in the market? Well, you can also take advantage of other solutions that we offer at GC Markets. Now, one of them is called a MAM, or a multi-account manager. Now, in a MAM, or a multi-account manager, what that means is you have experience. They have experience. They are experienced traders on our platform, using our platform, that have been trading for a long time and have proven track record. So they have a good track record, and they've been consistently profitable over time. Now, what that man does for you is, you don't, because you don't know a lot about trading, but you also want to start making money already. So what you can do is create an account. You fund your account. When you fund your account, you can now connect your account to a man manager. And one of the man managers, which is an independent forex trader on our platform, would manage your account. So the trader will trade, and the trades taken on the account will be reflected on your account. Although you have to go into an agreement with that particular independent traders, which would involve profit sharing. So the way it works is, you fund your account, which is around the minimum of $1,000 for the MAM, and then you can now trade. You can now copy the trade. You don't have to do anything. These things will be done automatically. The copy tradings will be done automatically. You just monitor your trade. You have your account connected maybe to your phone or your laptop, so you can see exactly what is going on. Now, it's a profit sharing system where the profit is divided. The profit made by the man manager is now being split between you and the man manager. So just the profit made is being divided between you and the man manager. Another one is also the copy trading. The copy trading is quite similar to the man, but the difference is, on the copy trading, you have to pay, you have to get a VPS to host your account live 24 hours, so that whenever the trade copier takes a trade, it is automatically done or copied to your own account. And you also have to pay the fee. That one is a monthly fee, straight up, irrespective of how the trades go. Although these traders are also experienced independent forex traders who have proven track record of being consistently profitable in the market over time. Now, another one is also, maybe you have some experience or you want to learn how to trade, and but you also want to be able to make some money. You can also join if you fund your account, and you have an account with us and you fund your account, your forex account. You'd also be added to our private Telegram channel for our funded clients, where we give out some trade advice and signals for traders, so you can take those trades personally on your own, and also make profit from the market. And if you sign up, if you create an account, you fund your account now, you'll also be entitled to the 100% deposit bonus. So this 100% deposit bonus you're entitled to it if you fund your account. Now it's not available indefinitely, but it is available now. So you want to take advantage of that. You would also need to create your account and fund your account with us. So subsequently, we will now, after we've broken this down, we'll be looking at technical analysis. Why technical analysis will explain. I showed you the charts and what I'll be looking to do and how the market works. But in order to understand in depthly how to analyze this chart yourself, you need to have an idea or become more or less a technical analyst. And so, would help you here. Our trainings would do just that. Would teach you help you understand support and resistance, help you master the sign language of the market in terms of candlestick patterns. Would also look at Fibonacci's and Elliott wave, and then we'll see how we can piece this up together. Now, one other very important thing, which there are a lot of traders who they know a lot about the technicality of trading, but they don't consistently make money in the forex, and this is because they've not defined their trading edge, and they don't know how they're not good at trade management and trade psychology. Now, this is something that we put our client to do. When you're done with the course, you would also be able to learn a lot about trade management, trade psychology, and how to define your trading edge, how to start using stuff like trade journals, and why it is very, very important. Money making in the forex market is not a secret. It is a formula. And so you want to hop on the channel that here you can get a formula to be able to trade the market. A lot of people don't make money in the forex market because they are doing it wrongly. If you learn how to trade the market well, then you will also be able to join the people who do make money in the market by doing it correctly. So now is the time I would open the floor up for your questions and answers. I hope if you have questions, I hope you've been dropping them. So remember, we have some of our GC Market Solutions. You have the MAM. You also have the the copy trading. So you don't need to, you don't need to know how to trade to already start making money in the forex market. What you just need to do is connect your account to an independent trader with a proven track record and benefit from their knowledge. So imagine having to you're just sitting down. I'll do the analysis. A trader like me would will have his do his analysis and take his trades, and automatically you have those things reflected on your account. You also have the copy trading, and then if you have some experience trading, once you fund your account, you also be added to our Telegram channel, which so far has been great. Our traders there have been they have been making profits from the signals that have been given. You can also take part of that. So if you're in our tradings for the first time, or if you don't have an account with us, you'd want to and you'd want to maybe send a message to the agent who calls you, and he would gladly help you through that. Okay, so Kazim, you said, what is the percentage of the profit sharing for the MAM account? So the percentage of profit sharing is, I think it's 70/30, and the is 70/30. But for the MAM account, there's also a minimum fund. I think it's around it for depending on the MAM manager. But for one of them, is I think $1,000 is the minimum fund, and the percentage sharing or the profit sharing is 70/30. So 70 to you and 30 to the MAM manager. See the agreement, rich man, you're saying the agreement with the MAM is general agreement, so just between the person and the MAM. Yeah, it's a general agreement, like yeah, between you and the MAM. It's just saying, it's simply saying, okay, I'm hand out, allow you manage my account. These are independent traders. They're not just so you're saying I would allow you manage my account because I've seen the track record. You have access to the track record to be able to see what they are doing, and then you're saying an agreement, okay, I'll allow you manage my account, and I also agree that I would also share profits that I mean. This is one excellent way to make money in forex markets because if you're learning is very 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 important because at the end of the day to really really become key to be in charge of your finance. When you learn this, you make your money by yourself. You choose what to do and what not to do. But while you're learning, you can also be making money. Imagine if he makes 40% of your money or 20% of your money, maybe even if it's 10% every month, and you take 10% of $1,000, you just have instead of the money sitting in your bank account and the bank taking out the money from it for interest and all of those for services or charges and all of those things, you have your money working on your behalf. So Kazim, you said how is it different from copy trading? Well, it's the difference between that and the copy trading is actually the fact that on copy trading you're paying for you have to get a VPS. So you have to get a VPS, a virtual private server, so that you can host your account live 24 hours a day. So you pay for the VPS, you get the VPS provider, and you pay for it, and you have to pay for that monthly. You also have to pay for you have to pay upfront for the signals, like for copying the trade, irrespective of what the trader does. So if he doesn't make money, he makes money that month. Let's say if he doesn't make money that month, or if it doesn't make enough, you'd still pay up for the trades that are being copied. Before you have to pay for it upfront. But with the man, you only pay him from the profit. So it's the profit that is shared. I don't know if you get the difference. So the man profit is shared. On the copy trading, you pay upfront for you get a VPS, and then you also pay upfront for the copying of the trades. So depending on the independent traders that you're trading with, you would it might all be $30 per month, $50 per month, $20 per month. If you can buy 68, depending. So that is the difference. Okay, so thanks everyone once again. Do have a lovely day.